My name is Nur Nabila binti Faisa Izham and my matrix number is 310494. Our group will be presenting our assignment on cost volume profit or CVP analysis. In this presentation, we will use the CVP method to help manage and solve businesses problems based on a given scenario. The company involved in this case is Aurora Wellness, Sindian Berhad, a health and lifestyle enterprise that offers premium supplements and holistic wellness products. In the year 2025, the company successfully sold 45,000 units, generating total sales of 900,000 ringgit. To promote the products, the company uses sales agents, and currently, these agents receive a 50% commission on each sale. CVP analysis is an important accounting tool because it helps businesses understand the relationship between cost, sales volume, and profit. Through CVP, management can make better decisions related to pricing, sales target, and cost control. By applying CVP analysis in this case, we aim to evaluate the company's performance and determine strategies that can support better planning and long-term business success. With that, let us move on the next part of our presentation.
Assalamualaikum and hi everyone. Today I will explain question 1 part A, which is the calculation of the sale price per unit of the product. Based on the information given, the company sold 45,000 units with total sale of 900,000. Other details such as selling commissions, variable costs and fixed costs are provided, but for this part we only focus on total sale and units sold. The formula used to calculate the sale price per unit is sale price per unit equal to total sales divide unit sold. So, we divide 900,000 by 45,000 units. 900,000 divided by 45,000 equals 20 per unit. Therefore, the sales price per unit of the product is 20. This is the answer for questions 1 part A. Next, I will be presenting the calculation for the total variable cost based on our current sales data. To find the total variable cost, we use a simple formula. Total variable cost equal to variable COGS plus sales commission. Now, let's go through the calculations. Step 1, we calculate the sales commissions. That is 50% of our 900,000 sales, which equal 135,000. Step 2, we add that commission to our variable COGS of 450,000. The calculation 450,000 plus 135,000. This brings our total variable cost to 585,000.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Afiq Azizi bin Rozaki. My nometry is 310483. Today I will be explaining question 1 sub-question C, which is variable cost per unit. So how do we calculate variable cost per unit? The formula for it is variable cost per unit equals to total variable cost divided by total units sold, which is in our case 585,000 ringgit Malaysia divided by 45,000 units equals to 13 ringgit Malaysia per unit. That is our variable cost per unit. Next is sub-question D, total fixed cost. The formula for it is total fixed cost equal to fixed COGS plus fixed advertising plus rental plus admin salaries plus insurance. So the calculation for total fixed cost is 90,000 plus 22,500 plus 18,000 plus 45,000 plus 30,500, which is equal to 189,000 ringgit Malaysia total fixed cost.
Assalamualaikum and hi. My name is Nur Farhan binti Amran. My metric number is 310450. Next, moving on to the contribution margin per unit. The contribution margin per unit is calculated by subtracting the variable cost per unit from the selling price per unit. The selling price per unit is RM20 and the variable cost per unit is RM13. Therefore, the contribution margin per unit is RM7. This means each unit sold contributes RM7 toward covering fixed cost and profit. Next is the contribution margin ratio. The contribution margin ratio is calculated by dividing the contribution margin per unit by the selling price per unit. That is RM7 divided by RM20. So, the result is 0.35 or 35%. This means 35% of each sale ringgit contribute to fixed cost and profit.
Assalamualaikum warahmatullahi wabarakatuh. Nama Muhammad Syahid, nombor metrik 310486. I will talking about question number 1 about the break-even point or BEP in the unit. Formula break-even point in the unit is fixed cost divide selling price minus variable cost. Correction I get based on question 9,000 divide 20 unit minus 10 unit get 19,000. So what break-even point in the unit is 9,000.
For this part, I will explain how to calculate the break-even point in amount, which is in Ringgit Malaysia. Break-even point refers to the level of sales where total revenue is equal to total cost, meaning the company makes no profit and no loss. The formula used to calculate BEP in RM is break-even point equals fixed cost divided by contribution margin ratio. Based on the information given, the fixed cost is 189,000 ringgit and the contribution margin is 0.35 or 35%. To calculate the break-even point, we divide 189,000 ringgit by 0.35. After calculation, the break-even sales amount is 540,000 ringgit. This means that the company must generate at least 540,000 ringgit in sales in order to cover all its costs. Any sales above this amount will result in profit, while sales below this amount will lead to a loss.
Next, this question asks us to identify the numbers of units that must be sold in order to achieve a net income to sales ratio of 30% in 2025 and to describe possible actions the company should take. First, we use the basic formula. Sales equal to variable cost at fixed cost at net income. We are given that variable cost is 35% of sale, which is 0.35 sales. Net income target is 30% of sales, which is 0.30 sales. Fixed cost is 189,000. So the equations become sales equal to 0.35 sales at 189,000 at 0.30 sales. Next, we combine the variable cost and net income. Sales equal to 0.65 sales at 189,000. Then we rearrange the equations. Sales minus 0.65 sales equal to 189,000. 0.35 sales equal to 189,000. By dividing 189,000 by 0.35, we get sales equal to 540,000. This means the company needs total sales of 540,000 to achieve the target. Given that the selling price per unit is 20, we calculate the target units 540,000 divide 20 equal to 27,000 units. Therefore, the company must sell 27,000 units to achieve a net income to sales ratio of 30%.
For question 3, the company is not able to increase the number of units sold, so the number of units remains at 27,000 units. The target operating income is 30% of sales and variable cost is 35% of sales with fixed cost of 189,000 ringgit. Using the CVP formula, operating income equals sales minus variable cost and fixed cost. After substituting the values, the required total sales is 540,000 ringgit. Since the number of units sold remains unchanged, the selling price per unit is calculated by dividing total sales by the number of units sold. Therefore, the selling price per unit is 20 ringgit. This means the current selling price is sufficient to achieve an operating income of 30% of sales.
Next, we're moving to question 4. First, we need to determine the new variable cost per unit based on the 55% COGS variable cost requirement and the existing sales commissions. We need to calculate the new variable cost per unit starting from selling price, which is 900,000 ringgit divided by 45,000 unit equals to 20 ringgit Malaysia. And our new variable COGS is 20 ringgit Malaysia multiplied 55% equals to 11 ringgit Malaysia. And sales commission is 20 ringgit Malaysia multiply 15% equals to 3 ringgit Malaysia. And our total new variable cost is 11 ringgit Malaysia plus 3 ringgit Malaysia equals to 40 ringgit Malaysia. The next step is to calculate the new total fixed cost. Our existing total fixed cost is 189,000 ringgit Malaysia. So 189,000 plus the new expense, which is 3,000. So our new total fixed cost is 192,000 ringgit Malaysia. Last one is project profitability 2029. The new sales volume is 45,000 plus 200% increase in sale multiply 45,000 equals to 135,000 unit. The new contribution margin per unit is 20 ringgit minus 14 ringgit, and we got 6 ringgit. So the total contribution margin 135,000 multiply 6, we got 810,000 ringgit Malaysia. So the project net income is 810,000 minus 192,000 equals to 619,000 ringgit Malaysia. Justification for the question. The company has the possibility to proceed with the plan because there is an increase in profitability, volume compensation, and improved margin efficiency.
I will explain question 5. Question 5 talking about difference in cost increase between our agent and seller agent, who are asked to increase the commission from 50 to 20% and give advice on whether to improve or not and choose between our agent or seller agent. Our agent need to be paid a salary and given a commission. However, seller agent are only given a high commission. At first, I will calculation the cost of our agent. Both seller agent so the calculation is did not improve the agent request to increase the commission to 20% because the cost will increase by 81,000 from using your agent. Because about that, I suggest to use our agent. Sekian, terima kasih.
Based on the analysis, there are 4 main recommendations to improve the company's performance in 2025. First, the company should improve product quality and value to strengthen brand image and customer loyalty. Higher product quality can justify a higher selling price and increase customer loyalty, which will help improve profit margin. Second, the company should expand sales channel by using online platforms and partnerships to increase sales volume. Third, the company should control and reduce operating costs, especially sales commissions and administrative expense. Finally, management should continue applying CVP analysis for better decision making. CVP analysis help management understands how changes in cost, selling price, and sales volume affects profitability. In conclusions, the cost-volume profit analysis provided valuable insights for managerial decision-making at Aurora Sendirian Berhad by controlling costs, setting appropriate selling price, and planning sales volume effectively. The company has strong potential to improve profitability and achieve long-term growth.